Welcome to the Cardinal Commentary for the foreign equity portfolios. Global stock markets surged in the third quarter, led by Japan's Nikkei 225, which rose 11.8%, followed by the UK's FTSE 100, which gained 7.5%. Germany's DAX 30 was the only major index to decline, falling 0.1%. Associate Portfolio Manager David Aime discusses how AI-driven investments shaped market performance during the quarter.
Announcements on AI-related investments drove the overall market in the US during the quarter. So the main beneficiaries are the ones with direct AI exposure, but we also saw benefits go to the peripheral companies like banks and industrials and utilities who also benefit from the overall AI spend.
The U.S. Federal Reserve's first rate cut since late 2024 helped fuel the continued stock rally by improving market sentiment.
The U.S. Federal Reserve resumed lowering interest rates in September. This was the first time that they had cut rates since December of 2024. There have been a few industries that have faced some headwinds from higher interest rates. Construction and housing have been two of them. And we think with these lowering interest rates that we should see some re-acceleration in these industries. There are many companies within our portfolio that we think should benefit. Two of them would be Home Depot and United Rentals. With Home Depot, there's been a lot of equity built up within the housing market. And with the rates coming down, this should allow consumers to tap into that equity through lower financing rates. United Rentals has been performing well because of its exposure to mega projects like data centers and utilities. But some of its smaller customers have deferred projects with these higher interest rates and uncertainty in the economy. So as the interest rates come down, we should see an acceleration in those smaller projects.
With these trends well underway, our outlook for global equities remains optimistic.
We still have a positive outlook overall on the stock market and our portfolios. One of the big reasons is that we're still seeing strong earnings and dividend growth for our companies. The valuations of our holdings and the stock market are still reasonable compared to their historical ranges, outside of a few areas where we've seen them trade at elevated levels.
Senior equity analyst Robert Lamb also sees opportunities emerging in the global technology supply chain, particularly through Taiwan Semiconductor.
So Taiwan Semi is the world's largest semiconductor foundry. So what they do is they manufacture chips designed by their clients including Apple, Nvidia, AMD, Qualcomm. They have a 60% plus market share of overall foundry activity, and they manufacture over 80% of the high-end chips. So Taiwan Semi has plans to have approximately 30% of its advanced manufacturing facilities in Arizona. This expansion in the US might not help margins, but we think it helps to strengthen its supply chain risks and eliminate a little bit of the geopolitical concerns that may exist with having all of their manufacturing in one place. So over time, while not necessarily margin accretive, we could see it lead to a higher valuation on the shares.
Across Cardinal's foreign equity portfolios, AI infrastructure, rate support, and dividend growth remain powerful themes. We continue to focus on high-quality global leaders positioned to compound value over the long term. And here's the proof. If you had invested $500,000 in the foreign equity portfolios in 2002, it would be worth about $3.9 million today, outstripping the benchmark by almost $800,000. And all of this demonstrates our commitment to clients, a common-sense path to long-term wealth. Because it works. And that's the Cardinal Commentary for the foreign equity portfolios. Thanks for joining us.